3M is up big this morning. They just settled their last pending big lawsuit. They settled one a few weeks ago. Now they have these ones involving the earplug settlement with the military, 300,000 claims. There were some estimates of $10 billion to settle this. And look at this, guys. $5.5 billion. That explains why the company's up almost 7% this morning. Let's see what's up right now. We can go to our software, pull up 3M. 3M's up 5.5%, so it's pulled back a little bit. Now, in full disclosure, I own 3M. That does not mean you should buy 3M. Please don't buy it just because somebody on the internet says that they own it. That is the worst. Even if Warren Buffett owns it, you shouldn't buy it for that reason. We are here on this channel to teach a process. No matter if you're a beginner investor or an advanced investor, there's something in these videos to learn from for everybody. We're here to teach that process. That way you can apply that to the things that make sense to you in your life with investing. So please follow us. I guarantee the more you follow us, the less you will fear in investing. And that's what's most important, because the more you know, the less you fear. And that's really big. So let's check out 3M today. All-time high on 3M is $260 over 5.5 years ago, guys. And 3M's a major company, guys. This is not some company that's a fly-by-night new one. This is a company that makes Post-it notes. They make a lot of big things for the world that we don't even notice. But they're, in my estimations, they're going to be around for a very long time. And my estimations aren't based on any sort of algorithm or anything. It's just saying, hey, these guys make a lot of things for a lot of people. And they're under the radar. But they're out there and people rely on them. And I think that's going to keep them around for a long time. Their market cap is $58 billion. That means if you wanted to buy every share outstanding in the market, you'd spend $58 billion. Now, here's something that's interesting. Their last 12 months net income shows a negative $1.5 billion. But their last 12 months free cash flow is a positive $4.5 billion. How can that be? Well, they probably had some write-off in here that really dropped down their net income. Remember, net income has accounting rules, SEC rules, all these different rules that apply that might not necessarily show the cash flow. My guess is this involves their settlement they had recently or some sort of settlements they had before the earplug settlement. But they're going to pay that out over the next 13 years. So it's going to affect their cash flow for the next 13 years, but a big part of it's written off maybe today. Now, again, I'm estimating here, but we can go look at their income statement and see in the last year what happened. Yep, let's see here. SG&A expense. We did a video last week. This is their SG&A expense skyrocketed. And a big reason was that lawsuit that they settled that really drove up. It should have been a special income or charge, but that's okay. All right. So 8 pillars on 3M. Again, if you have our software, you can customize your 8 pillars here. You can go up to 12 pillars and 4 quadrillion different variations. But net income's down, obviously, with this big net income drop over the last 5 years. And actually, free cash flow is down. But look, again, net income is down $6.4 billion. Free cash flow is only down $940 million. All right? So they can spend the next few years as they pay out this settlement to increase their free cash flow along the way. Here's something I love about 3M. Profit margin. Their 5-year profit margin is 11.2%. And actually, if you look at not just the last year, their profit margin overall is about 11% pretty consistently across the board. And that's pretty good. When you have a company this big having the same profit margin, I like that a lot. Do we have a free cash flow margin here? Let's go to our stock analyzer tool because it'll show us our free cash flow margin. Look at that. Free cash flow margin, very healthy. Lower in the last year, but in the last 10 years and 5 years, 15%. They're showing higher free cash flow than they do net income. I like that a lot, okay? I'd rather have it that way than the other way around. Because remember, free cash flow is cash from operations less your capital expenditures. That's the real lifeblood of the business. They take their normal business, this is what they generate, they subtract out the capital expenditures. What are capital expenditures? The investments back into their company, into the fixed assets. Like if they build a plant or they build a new building or something like that, that is their capital expenditures. And what's left over is the free cash flow. That's what they can use to buy back shares, pay down debt, pay a dividend, invest in themselves, or make acquisitions. All right. Now, the boring part about 3M is right here. The revenue growth isn't that great over the last 10 years. It's not great. I don't like that. But with that said, they're a company that does a lot of different things. So I imagine as inflation has reared its ugly head, their revenue will jump up with inflation. Their revenue will go up with inflation. Let's go check out some analyst estimates on 3M to see what their let's start with revenue. Yep, look at this, guys. Revenue growth, boring 3% a year, 3 to 4% a year. And that's about expected, I would guess, for a company like 3M, right? They're making everyday stuff. So it's like, okay, as costs go up, their revenue will go up along the way. And we haven't had much inflation in the last 10 years. And the reason their revenue probably isn't up a ton is I actually think they've been selling off divisions. So look on their cash flow statement right here. They've had some acquisitions and dispositions. If it's a positive number, they got money in, which means they sold something. If it's a negative number, they bought something. So a couple net sales here, big purchase, small purchases, sell off, big purchase. So it'd be interesting to figure out if they'd kept everything here back in 2014, all their divisions, all their companies, what their revenue would be today. So I don't know what that is, but I'm hoping that, when a company sells to consumers, they have to keep up with costs. And then, they have their costs, their labor costs, their R&D costs. They have to go up with inflation, unless they're willing to take a much, much lower profit margin. However, as I've said to you guys here, to show you guys the last 10 years of profit margin, you've had, in fact, the last 5 years has had higher profit margin than the last 10 years. That's interesting, isn't it? That's pretty interesting. So it shows that they've kept up their costs and passed them on to the consumers as their costs went up, because their profit went up, right? The last 10 years, they've averaged 15.8. The last 5 years, 16.3. All right. Pretty interesting. Now, their net income's been a little bit different, but I really care much more about the free cash flow. That's the money that you can use. That's what determines everything. Net income is affected by all these different rules. Free cash flow is not as easy to manipulate. All right. So with this news on the settlement, a lot of people are excited about this. Guys, I didn't really care. I knew it would get settled at some point. The question is, if they were settling for $10 billion, just like the other one they did, or whatever amount of money that was, it was going to affect their cash flow for a few years. But it was something that I thought 3M can afford this. Yes, it's a big, look at their market cap, $58 billion. $58 billion. These two settlements have cost 15 or $16 billion. That's a big chunk of their market cap. But let's go look and see how much cash they have on hand. This is my first time looking at their cash position. About $4.3 billion. So they have to finance this over time. And I don't know how much is covered by insurance or if anything is covered by insurance. I have no idea. But the bottom line is, I thought to myself, this is a company that generates $4 or $5 billion a year, and they're going to finance this over 10 years or whatever the number is. They can easily afford that. Even if it's $15 billion, it's $1.5 billion of their free cash flow every single year for the next 10 or 15 years. Okay. Again, it is a lot of money. Don't get me wrong. This is not to sit there and say that $1 billion to $1.5 billion a year for 10 years is not a lot of money. It's a lot of money. However, it is something that 3M, I think, can afford. And that's what's key here. When you find negative news about a company that people really harp on, unknowns are bad things for the public markets. People don't like unknowns. I like it when people overreact to unknowns. So I thought to myself, 3M will likely still be around, and they'll be able to afford whatever settlement they end up doing. Okay, go from there. So the question becomes, well, actually, let's look at analyst estimates on earnings per share. Not huge. They're expected to make $9 a share this year, increasing to $11.47 in 2027. Not big growth, but here's the thing that's going to attract a lot of people. The dividend yield, 5.7% in the last year. So the question becomes, is that dividend affordable? Well, look at this. Dividends paid is $3.32 billion. In the last 5 years, they've averaged $5.4 billion. Usually I like it to be under 50%, the dividend be under 50%, the 5-year free cash flow. But 3M's a much more mature company. You know what I actually wish they were doing? Wish they were buying back shares. Buying back shares instead of paying this dividend. But now they're going to decrease their free cash flow by $1 or $1.5 billion a year. It makes this a little bit harder maybe. So I would be a little apprehensive if you're only buying 3M because of the dividend yield. If I'm 3M and I'm going to lose $1 billion to $1.5 billion in free cash flow the next 10 years, first thing I'm going to do is cut my dividend and say, listen, we got to pay this thing out. So I'll cut my dividend. Now, does that cut the dividend to zero? No, but maybe it goes from 5.7 to 2.5% or 3%. All right, maybe so. Not bad. Okay. But they've been paying out a big dividend for a while. Now, when the stock was 260, that wasn't a big dividend, right? Because when it's 100 right now versus 260, it takes the dividend yield from 5.7 to like 2 to 2.5%. So now they might sit there and say, listen, our stock is down. Let's keep the dividend lower, still pay a good dividend, 2.5%, 3%. But now we'll use that savings and cash flow to pay out the settlement. I'm not saying this is for sure, but this is what I'd be thinking if I was 3M. So the question becomes, what price do we pay for 3M? Now, we just did this a few weeks ago. Now, let me go over I'm going to look at our history, our assumptions on 3M. By the way, it's already down. It's now only up 4.9%. So it's pulled back a little bit since we started this video. But these are my assumptions on 3M for the next 10 years. 1%, 3%, and 5% revenue growth, profit margin of 10, 12.5%, and 15%. I did the exact same thing for free cash flow, even though free cash flow has been higher than that over the last 5 and 10 years. I still want to be a little bit conservative. PE, I did 13, 15, and 17 because I actually did 13 because of the unknowns on this lawsuit. I was like, okay, so now that we have the knowns in the lawsuit, I think the 13 is kind of low. And for a company as big as 3M, look at this 10-year return on invested capital, 14.3%. It's been greatly affected by this 1 year. This means the money they're invested in the business. What's the return they're getting on that money? The higher the return, the faster they can compound earnings. And the more and more earnings they can generate for you. The question is, do they have a lot of reinvestment opportunity? I don't know. Probably not for a company like 3M. That's why they're paying such a big dividend. But it shows the stability of the company as well. And that's important. So stay with me just a little bit longer, one more minute. I made my desired annual return 10, 12, and 14% on this company because on the low side, I really beat it up. So I don't need as high a return here. Because I already beat this up so much, I don't need as high a return. We hit the analyze button, and the value we came up with, low side 67, high side 120, middle 93. It's on my watch list at 90. If you pay today's price and the low assumptions occur, you'll make about 4% return. This includes the dividend. Middle assumptions occur about 10.5. High assumptions occur 16.4. So guys, this is 3M. Thank you very much. And please do me a favor. Subscribe to our channel. We do these updates all the time, and 3M was a big company. And again, don't buy 3M just because I own it. Thank you for your time.